The date is September 6, 1915. Robert Lansing, Secretary of State of the United States, sits at his desk in Washington and writes a private memorandum. Not for Congress, not for the press, for himself alone. He writes the phrase, "financial crisis of the first order." He is not describing Germany's military machine. He's not describing submarines in the Atlantic. He is describing what happens to American banks if Britain and France lose the war. At this exact moment, Woodrow Wilson stands before the American public and declares neutrality. He tells the nation America has no quarrel with Europe. He tells the nation American boys will not die in foreign trenches. He tells the nation the United States will observe the bloodiest conflict in human history from a position of principled distance. Lansing's private memorandum tells a different story. By September 1915, American financial institutions have already lent the Allied powers over $1 billion. J.P. Morgan, appointed as sole purchasing agent for Britain and France, has routed $3 billion in war procurement orders through American factories in Pennsylvania, Ohio, Massachusetts, and New England. An Allied defeat does not produce a distant geopolitical shift. It produces a domestic financial collapse, and every senior official in Wilson's inner circle knows it. Lansing's memorandum is not classified. It is not suppressed. It sits in the Library of Congress Manuscript Division, accessible to any researcher willing to look. It simply does not appear in the history textbooks assigned in American schools. Today, you will read the documents. You will trace the money. You will understand why April 1917 was not the moment America chose to enter the war. It was the moment America acknowledged it had never truly stood outside it. This is Noob Historian. Every war, every empire, every revolution has a price tag. We find it. On August 4th, 1914, Woodrow Wilson issued a formal proclamation of American neutrality. The United States would remain impartial in thought and deed. 2 weeks later, addressing Congress, he called on Americans to be neutral in fact as well as in name. These words were broadcast to the nation. They appeared in every major newspaper. They became the official American position for the next 2.5 years. The financial reality operating beneath those words was something else entirely. In August 1914, the Wilson administration faced an immediate structural problem. Britain and France needed to purchase war supplies from American manufacturers. American manufacturers needed to be paid. European gold reserves were already depleting at a rate no prior war had required. The Allied powers needed credit, American credit, and they needed it quickly, at scale, and on a continuing basis. Secretary of State William Jennings Bryan, the original architect of Wilson's neutrality posture, held a firm line. He told Wilson American loans to belligerent nations were incompatible with genuine neutrality. Money, Bryan wrote in a 1914 memorandum, is the worst of all contrabands because it commands everything else. He blocked formal loan arrangements for the first months of the war. Bryan's position had internal logic. If American banks lent money to one side in the war, American financial interests became structurally tied to one side's survival. Genuine neutrality required financial distance. Bryan understood the mechanism, and he refused to authorize arrangements undermining it. Bryan resigned in June 1915 over a separate dispute with Wilson on the American response to the Lusitania sinking. Robert Lansing replaced him. The neutrality policy did not survive the transition intact. Within months of Bryan's departure, the administration quietly reversed its position on Allied credit access. The distinction drawn was between loans, remaining technically restricted under the original policy, and credits, falling outside the restriction. In financial practice, this distinction was meaningless. Money moved from American institutions to Allied governments. The vocabulary changed. The flow of capital did not. By October 1915, the Anglo-French loan of $500 million was fully subscribed and underwritten by J.P. Morgan. It was the largest foreign loan arranged in American financial history to that point. Morgan advertised it to American banks and investors nationwide. American capital flowed to London and Paris at a scale Bryan had specifically warned against. Wilson's public statements on neutrality remained unchanged. His private correspondence tells a different story. In correspondence with Colonel Edward House, his closest foreign policy advisor, Wilson acknowledged the growing financial entanglement in 1915 and expressed concern about the consequences of Allied financial failure. The House papers at Yale University hold this correspondence. Historians have cited it for decades. It does not appear in standard survey textbooks assigned in American secondary schools or undergraduate history courses. The neutrality Wilson performed on public platforms was real in the sense of official declaration. It was not real in the sense of financial independence. Every month the war continued. American institutions deepened their exposure to Allied survival. Every month, the structural cost of genuine neutrality increased. By late 1916, the cost had become prohibitive in any realistic financial analysis. You need to understand the scale of American industrial gain from Allied procurement to grasp why financial neutrality was always a performance and not a policy. Between 1914 and 1917, American exports to Britain and France increased from approximately $800 million annually to over $3 billion annually. American steel production, munitions manufacturing, chemical plants, and textile mills ran at capacity on Allied contracts, coordinated through J.P. Morgan's purchasing operation. Pennsylvania, Ohio, Massachusetts, Connecticut, and New York were all economic beneficiaries of Allied survival. Their factories, their workers, their local financial institutions, their elected representatives, all held a material stake in the outcome of a war Wilson publicly claimed to observe from neutral distance. This is not a conspiracy framing. This is documented commerce. The records are in the National Archives, in the Morgan Library, in the Federal Reserve's own archives. The money trail is not hidden. It is underemphasized in the standard historical narrative presented to the public and to students at every level of American education. The gap between Wilson's public posture and the financial architecture developing beneath it grew wider with each passing month of 1915 and 1916. By the time the United States faced its decisive moment in early 1917, the financial entanglement had been building for more than 2 years. The War Declaration of April 1917 did not produce the entanglement. The entanglement produced the conditions, making April 1917 structurally inevitable. In August 1914, the House of Morgan stood as the most influential private financial institution in the United States. It had reorganized American railroads during the 1890s financial consolidation. It had provided emergency Treasury financing in 1895 when President Cleveland needed gold reserves to defend the dollar. It had coordinated the private financial response to the Panic of 1907 before the Federal Reserve existed to perform regulatory functions. J.P. Morgan the Elder died in March 1913, but the firm he built continued under his partners with the same institutional authority and the same networks of influence in government and industry. In January 1915, the British government approached J.P. Morgan and Co. with a formal proposal. Britain needed a single American financial agent to coordinate war purchasing across multiple American industries simultaneously. The scale of Allied procurement requirements exceeded what individual British or French commercial relationships with American suppliers were able to manage efficiently. Britain needed a professional intermediary with access to the full breadth of American industrial capacity. Morgan accepted the appointment. The firm became the official purchasing agent for Great Britain and shortly afterward for France. This appointment is documented in the firm's own correspondence, in British Treasury records, and in the sworn testimony of Morgan partner Thomas Lamont before the Nye Committee in 1934. It is not a historical inference or an academic extrapolation. It is a documented commercial relationship with a signed contract and an organizational structure built around its execution. Morgan established a dedicated procurement division called the Export Department. At its operational peak, this division employed over 170 staff. It received requisitions from London and Paris, identified American suppliers capable of meeting those requisitions, negotiated contracts, arranged delivery logistics, and managed payment. Between January 1915 and April 1917, this operation placed approximately $3 billion in orders with American manufacturers. $3,019,17. Adjusted for inflation, this figure exceeds $100 billion in present purchasing terms. The factories receiving these contracts were not abstract economic units. They were specific employers in specific towns, with specific payrolls and specific local banks holding their operating accounts. Bethlehem Steel in Bethlehem, Pennsylvania. DuPont Chemical Plants in Wilmington, Delaware. Winchester Repeating Arms in New Haven, Connecticut. Remington Arms in Ilion, New York. American Locomotive Company in Schenectady, New York. These firms, their workers, their supply chains, and the financial institutions serving them were all materially tied to the continuation of Allied purchasing capacity. Morgan's operation did not place orders and step back. It created an industrial ecosystem dependent on Allied survival. A German victory and subsequent Allied default on outstanding loans and procurement contracts would send a severe financial shock through the industrial Northeast and Mid-Atlantic regions. The shock would land with geographic concentration precisely where American manufacturing was most concentrated, and where American financial institutions had the deepest industrial loan exposure. Morgan partners were not passive intermediaries in this arrangement. The firm actively worked to ensure policies favorable to Allied purchasing remained in place in Washington. It communicated regularly with the State Department and the Treasury. It monitored Allied financial reserves as a professional obligation attached to its role as purchasing agent. It worked to keep the credit arrangements supporting Allied purchases functional as Allied gold reserves depleted through 1915 and 1916. When the Nye Committee investigated the munitions industry and the banking sector's role in American intervention between 1934 and 1936, Morgan partners testified under subpoena. The full testimony is available in National Archives Record Group 46. Thomas Lamont, the firm's senior partner at the time, confirmed the purchasing agent role, the loan arrangements, and the firm's communication with government officials throughout the Neutrality period. The Nye Committee's political conclusions were disputed at the time and remain contested among historians. The committee operated in the political climate of Depression-era isolationism, and its framing reflected the politics of that moment. The documents it produced are a separate matter entirely from the committee's political conclusions. You do not need to accept the committee's framing to take the primary sources seriously. The Morgan purchasing agent contract exists regardless of the committee's political context. Lamont's testimony is on public record regardless of any interpretation placed on it after the fact. What the Morgan Archive establishes is structural. By 1916, American industrial capacity was not available in a neutral marketplace to both belligerent parties on equal terms. It was organized specifically around Allied requirements through a dedicated procurement apparatus run by the most prominent financial institution in the country. The organizational structure of American industrial production had already chosen a side. The political declaration had not yet followed. One additional dimension requires direct examination. Morgan's role as purchasing agent gave the firm both a financial stake and a reputational stake in Allied victory. A firm whose primary client relationship over 3 years of war was with the British and French governments, whose export department had placed $3 billion in orders, whose lending had financed Allied capacity, held interests extending well beyond any individual transaction. Allied defeat would mean default on outstanding loans, the collapse of the procurement operation, and severe damage to the firm's balance sheet and the relationship sustaining it. Morgan Partners communicated with Wilson administration officials throughout the Neutrality period. This communication is documented in both the Morgan Archive and in State Department and Treasury records. The content of those communications is a matter of ongoing historical research and interpretation. The existence of the communication is established beyond dispute by the documents themselves. Robert Lansing became Secretary of State in June 1915. He was a lawyer by training, methodical in his reasoning, and diligent in recording his thinking on paper. He kept private memoranda and personal correspondence throughout his tenure. These papers are held at the Library of Congress Manuscript Division and have been accessible to researchers for decades. The September 6, 1915 memorandum is the most significant document in this archive for understanding the financial logic of American intervention. Lansing wrote it 3 months into his tenure as secretary. He was working through the policy question of Allied borrowing access in the American market. Bryan's informal prohibition had been abandoned. The question before Lansing was whether to formalize and expand Allied credit access or maintain a nominal restriction serving political optics without financial substance. His private reasoning in the memorandum proceeds through a chain of economic logic. The prosperity of the United States depends on its export trade. Its export trade depends substantially on Allied purchasing power. Allied purchasing power depends on Allied credit access in the American market. If credit is denied, Allied purchasing power collapses. If Allied purchasing collapses, American export industries contract severely. If those industries contract, the financial institutions holding their loans and securities face conditions of crisis. Beyond this chain of consequences, Lansing writes directly, if the Allies lose the war and prove unable to repay their American creditors, the United States will face a financial crisis of the first order. This memorandum is not a war plan. It is a financial risk assessment. It reads like analysis a bank examiner would produce, not a diplomat. And this is precisely its significance. The Secretary of State of the United States, in a private document written 18 months before the war declaration, frames American foreign policy as a question of financial exposure management. He does not frame it as a question of democracy against autocracy. He does not frame it as a question of international law or the rights of neutral nations. He frames it as a question of what happens to American banks and American export industries if the wrong side wins. Lansing's public statements during the same period maintained Wilson's neutrality posture in every visible dimension. He managed diplomatic correspondence with the German government on submarine warfare. He communicated on neutral shipping rights. He administered the outward form of a neutral foreign policy with professional competence. Privately, by September 1915, he had already concluded genuine financial neutrality was structurally impossible, and Allied defeat would produce severe American financial consequences requiring active management. Historians disagree on the weight to assign this memorandum. John Milton Cooper, in his 2009 biography of Wilson published by Alfred A. Knopf, argues for the primacy of Wilson's genuine idealism as the driver of the eventual war decision. Cooper presents Wilson as a leader who believed in a peace settlement preserving international law and democratic governance, and who framed American entry as a moral and strategic necessity. Cooper treats the financial entanglement as a complicating factor, not the primary causation. His argument rests heavily on Wilson's personal correspondence and public speeches, both of which emphasize democratic principles and international law with apparent sincerity. Patrick Devlin, in Too Proud to Fight, Woodrow Wilson's Neutrality, published by Oxford University Press in 1975, weights the financial dimension more heavily. Devlin's analysis of the credit and loan architecture leads him to conclude that by late 1916, American policy had no neutral path available without severe domestic financial pain, regardless of whatever Wilson believed about democratic idealism. Kathleen Burke's Britain, America, and the Sinews of War, published in 1985 by Allen and Unwin, is the most detailed financial history of this period and the most thorough for primary source documentation. Burke worked directly with British Treasury records, Morgan correspondence, and Federal Reserve archives. Her conclusion? Allied financial survival and American financial stability had become structurally inseparable by mid-1916. The historical debate is genuine and worth your engagement. What is not debatable is the content of the Lansing memorandum. He wrote what he wrote. The date is September 6, 1915. The language is specific and unambiguous. When you read a textbook account of American entry into WWI centered on the Lusitania, unrestricted submarine warfare, and the Zimmerman telegram, those elements are real and historically documented. The submarine campaign was a genuine provocation with real casualties. The Zimmerman telegram was a genuine intelligence discovery with genuine strategic implications for American security in its own hemisphere. What the textbook account systematically omits is the Lansing memorandum and the financial architecture it describes as having foreclosed genuine neutrality before any of those provocations occurred. The provocations provided the public justification. The financial entanglement provided the structural necessity. These are not mutually exclusive explanations, but one has clear primary documentation written by the officials who made the decisions, and the other has better public relations. The Federal Reserve System was 3 years old when war broke out in 1914. Created in December 1913 to provide institutional stability after the financial panics of the late 19th and early 20th centuries, its board members were trained to assess and monitor systemic financial risk with professional attention. From 1914 onward, Federal Reserve officials monitored Allied credit conditions as a direct function of American financial stability. This monitoring is documented in Federal Reserve board minutes and Treasury Department correspondence, analyzed by Charles Gilbert in American Financing of World War I. Published by Greenwood Press in 1970 and cross-referenced in Burke's 1985 analysis with parallel British Treasury documentation. The Fed's sustained attention was not on military developments or diplomatic negotiations. It was on credit exhaustion rates, the pace at which Allied gold reserves were depleting, the accumulating weight of dollar-denominated debt carried by the British and French governments, the gap between Allied financial capacity and Allied financial requirements as the war extended far beyond the timeline anyone had projected in the summer of 1914. By late 1916, the picture inside those assessments was alarming. Britain had been the world's dominant creditor nation in 1914, the center of global finance, the holder of the largest foreign investment portfolio in history. 2 years of industrial-scale warfare had reversed this position, at a pace no peacetime analysis would have projected. British gold moved westward to pay for American supplies. British foreign investments accumulated over decades were being liquidated to raise dollars. The Bank of England was under sustained and increasing institutional pressure. In November 1916, the Federal Reserve Board took the unusual step of issuing a public advisory warning American banks about extending further unsecured credit to foreign governments. The advisory did not name Britain specifically. Every participant in the American financial community understood the reference. This warning produced an immediate disruption in Allied credit access in the American market. Morgan partners worked urgently to stabilize the situation through existing relationships. The British Treasury sent emergency communications to Washington through diplomatic and financial channels. The Fed's advisory was quietly walked back in subsequent weeks through informal coordination between financial officials on both sides of the Atlantic. The episode illustrates the degree to which Allied financial survival had become a managed operation by late 1916. It was not proceeding on standard market terms with willing lenders and creditworthy borrowers. It required active institutional intervention to prevent credit collapse. The Federal Reserve, the Treasury Department, the Morgan firm, and the British government were operating in coordination to keep an increasingly strained financial architecture functional. Wilson received briefings on these developments through Treasury Secretary William McAdoo and through Colonel House. McAdoo was Wilson's son-in-law and a fully informed participant in the financial dimensions of the neutrality question. His correspondence with Wilson on Allied credit conditions in late 1916 and early 1917 is available in the Wilson papers at the Library of Congress and in the McAdoo papers at the same institution. What the Federal Reserve Archive establishes is a timeline with documented detail. Allied credit exhaustion was not a sudden discovery made in April 1917. It was a tracked, documented, progressively worsening condition monitored continuously from 1914 onward by American officials responsible for financial system stability. The war declaration of April 1917 did not occur against a backdrop of stable Allied finances suddenly disrupted by the submarine campaign resumption. It occurred against a backdrop of Allied financial collapse in slow motion. watched in real time by the people responsible for preventing American financial instability. By early 1917, Fed internal assessments were direct in their conclusion. Allied dollar reserves were approaching exhaustion. Without American entry into the war, allowing direct U.S. government financial support to replace the failing private credit system, Allied purchasing capacity faced imminent collapse. And Allied purchasing collapse meant the manufacturing constituencies Morgan had built across the American industrial heartland faced a severe and sudden demand contraction with no alternative order source available. American entry into the war did not bring only troops to Europe. It brought the U.S. government's sovereign credit directly into the conflict. The Liberty Bond program, launched in April 1917, raised over $21 billion from American citizens over the course of the war to finance the military effort. A significant portion of this capital went directly to stabilizing Allied finances. The private credit structure assembled by Morgan since January 1915 was replaced by sovereign credit at far larger scale and with far greater financial depth. This transition from private credit to sovereign credit is the financial story of American entry into WWI. The War Declaration was also a financial rescue operation. This dimension of April 1917 is absent from standard textbook accounts in American education. On April 22, 1917, Arthur James Balfour arrived in Washington as head of a British diplomatic mission. He came 3 weeks after Wilson's War Declaration to Congress on April 2nd. The Balfour mission is documented in the British National Archives under Cabinet Series CAB 23. And the financial briefings prepared for the mission are among the most candid documents in the British Wartime Archive available to researchers. Balfour carried information the British government had not previously disclosed in full to American counterparts. Britain's dollar reserves, the foreign currency holdings needed to pay for all ongoing American procurement under every existing contract, had fallen to approximately $426 million. At the current rate of expenditure on American supplies and contracts, this represented approximately 6 weeks of import capacity. 6 weeks. Britain was not approaching financial difficulty in April 1917. Britain was weeks from complete financial collapse. The timing of Balfour's mission relative to Wilson's war message requires direct examination. Wilson delivered his war address to Congress on April 2, 1917. Balfour arrived April 22. The sequence matters for any serious analysis of causation. British cabinet records from late March and early April 1917, now available in the National Archives in London, show the British government was in active communication with American officials through diplomatic and financial channels about the reserve crisis in the weeks before the War Declaration. These communications were not made public. They did not go to Congress. They moved through the channels connecting the British Treasury, the British Embassy in Washington, the Morgan firm, and the American Treasury Department. The Zimmermann telegram, in which German Foreign Secretary Arthur Zimmermann proposed a military alliance with Mexico against the United States, was made public on March 1, 1917. Germany declared unrestricted submarine warfare on February 1, 1917. These are the public provocations and standard textbook accounts explaining why April 1917 produced a war declaration. What standard accounts rarely examine alongside those documented provocations is the financial backdrop against which Wilson made his decision. The public provocations gave Wilson a legitimate cause for war, a publicly defensible rationale for going to Congress. The financial crisis gave him a structural imperative operating at the same time, through different channels, with different documentation and with different levels of public visibility. Both existed simultaneously in the weeks leading to April 2nd. The provocations are what Wilson described publicly in his war address, in his public correspondence, in his speeches. The financial crisis is what his Secretary of State and Treasury Secretary were managing privately in memoranda and correspondence not intended for public view. Balfour's Washington mission resulted in the United States government arranging an immediate credit line of $200 million to Britain through the Treasury Department. Within weeks, the Liberty Bond program was announced, and Allied financial stabilization became a function of American sovereign credit rather than the increasingly strained private banking capacity Morgan had managed since 1915. The British financial crisis of April 1917 is documented in the British National Archives. The communications between London and Washington in the weeks before the War Declaration are documented in both British and American archives. Burke's 1985 work draws directly on the Balfour mission files and provides the most detailed published analysis of Allied financial conditions in the spring of 1917 available in the scholarly literature. When you place the Balfour mission files alongside the Lansing memorandum, alongside the Federal Reserve monitoring records, alongside the Morgan procurement archive, you are not looking at a single document proving a single claim. You are looking at a structural picture assembled from multiple independent archives held in multiple countries, and analyzed by multiple historians working from different methodological frameworks and different institutional positions. Each document on its own tells a partial story. Placed together, They describe a situation in which the United States government was financially entangled with Allied survival from late 1914 onward, in which its senior officials privately acknowledged this entanglement as early as September 1915, in which its financial regulators watched Allied credit approach critical failure through 1916 and into 1917, and in which the British government arrived in Washington in April 1917 with 6 weeks of dollar reserves remaining. The Lusitania was sunk in May 1915. The American government did not declare war in 1915. Unrestricted submarine warfare was declared by Germany in February 1917. The United States declared war in April 1917. The 2-year gap between the first major public provocation and the actual war declaration is not adequately explained by moral outrage on a timeline. It is adequately explained by the financial architecture, requiring from late 1914 to early 1917 to reach the point of structural crisis. The historians who studied this period with the greatest rigor do not agree on a single explanation for American entry into WWI. This fact is worth stating directly and without qualification. The documentary record does not support one clean thesis to the exclusion of all others. John Milton Cooper, whose 2009 Wilson biography remains a standard academic reference, argues for the primacy of Wilson's idealism. Cooper presents Wilson as a leader who genuinely believed in a peace settlement preserving international law and democratic governance, and who framed American entry as a moral and strategic necessity. Cooper treats the financial entanglement as a complicating background factor, not primary causation. His argument rests on the Wilson papers held at the Library of Congress and Princeton University, and it takes Wilson's stated convictions seriously as historical evidence. Patrick Devlin and Kathleen Burke, working from financial archives and British records, weight the economic dimension far more heavily. Burke's conclusion, drawn from the most extensive financial documentation in the published literature, is direct. By mid-1916, Allied financial survival and American financial stability had become structurally inseparable. And this structural condition shaped all subsequent decision-making, regardless of whatever Wilson expressed about democratic idealism in his public rhetoric. The Nye Committee, placing much of this financial record before the public between 1934 and 1936, drew the most aggressive conclusions of all. It argued Wall Street had effectively manufactured American entry into the war for financial gain. This framing was politically charged in the Depression era and remains contested among historians. The committee's political environment was one of growing isolationism and deep public suspicion of the financial sector in the aftermath of the 1929 crash and the misery of the Depression years. Its documentary findings are a separate matter from its political framing. You do not need to accept the Nye Committee's framing to take its documentary findings seriously. The Morgan Purchasing Agent contract exists regardless of the committee's political context. The Lansing Memorandum exists regardless of the committee's conclusions. The Balfour Mission files are in the British National Archives, regardless of anyone's political position on American intervention. What the documents establish, examined collectively and without political overlay, is the following. The Wilson administration reversed its position on Allied credit access within months of the war's beginning, allowing a financial relationship to develop and deepen over 2.5 years. The Secretary of State privately acknowledged by September 1915 genuine financial neutrality had become structurally impossible. An Allied defeat would produce severe American financial consequences. The most influential private financial institution in the country simultaneously served as purchasing agent, loan underwriter, and financial intermediary for the Allied powers, creating industrial and financial constituencies for Allied victory across the American manufacturing heartland. The Federal Reserve monitored Allied credit exhaustion continuously from 1914 onward, and watched it approach critical failure through 1916 and into early 1917. Britain arrived in Washington 3 weeks after the war declaration, with approximately 6 weeks of dollar reserves. And the war declaration was immediately followed by sovereign credit arrangements at the U.S. government level, replacing the failing private credit structure. These 5 points are documented in named archives with record group numbers and manuscript division citations. They are not speculative. They are not dependent on any single historian's interpretation. They are verifiable by any researcher willing to do the work of accessing the primary sources. The question the documents raise is precise. It is not whether financial entanglement existed. It did. The question is whether Wilson's war decision was primarily caused by financial crisis, primarily caused by genuine moral and strategic conviction, or produced by both operating simultaneously in a situation where the financial architecture had already foreclosed genuine neutrality as a practical option. This is a legitimate historical debate among serious scholars, and it deserves engagement on its merits. What falls outside legitimate historical practice is presenting American entry into WWI as purely a response to German aggression and Wilsonian democratic idealism, while omitting the Lansing Memorandum, the Morgan Purchasing Agent structure, the Federal Reserve monitoring of Allied credit exhaustion, and the 6-week reserve figure the Balfour mission brought to Washington. The official story and the financial story are not contradictions requiring you to choose between them. They are layers of the same event, operating at different levels of public visibility. The submarine warfare was real. The Zimmermann telegram was real. The financial crisis was also real. The provocations gave Wilson the public justification. The financial architecture gave him the structural imperative. Both operated on April 2, 1917, in the same decision, made by the same man, against a backdrop of information his public speeches did not reflect. The reason this matters in 2026 is direct and requires no forced analogy. Western governments are currently involved in substantial financial commitments to Ukraine's defense and reconstruction. These commitments are described publicly in terms of democratic values and security interests. The WWI precedent does not prove financial entanglement causes war. It establishes, with the best primary documentation available for any comparable historical event, that financial entanglement constrains the foreign policy options of creditor nations in ways decision-makers do not typically communicate to their publics. When a government lends money to a foreign power at scale, it acquires a structural interest in the survival of the borrower. When this interest reaches systemic scale across the banking sector and the industrial sector, it becomes a factor in strategic decisions regardless of what other factors are publicly cited. The Lansing Memorandum of September 1915 is the most honest surviving articulation of this principle from inside any government of the early 20th century. A senior official wrote down what was driving policy. He wrote it privately. He never published it. Go to the Library of Congress Manuscript Division. Read the Lansing Papers. Read the Federal Reserve Board minutes from 1916 and 1917. Read Kathleen Burke's 1985 analysis. Go to the British National Archives online portal and read the Balfour Mission files in the CAB 23 series. The documents are available. The question is whether you choose to read them. This has been Noob Historian. The official story is the public record. The money trail is the full record. We follow both.